Good morning, everyone. How's it going? It is half an hour before the open on November 30th. It's the last day of November. We're getting super close to the end of the year, which is kind of crazy to me. It's been going by so fast. Let's take a look at how our futures are doing. And we are up, and we are up significantly. So about a third of a basis points over here, or a third of a percentage point, so about 30 to 35 basis points over here in the S&P 500. Looks like the same for the Dow, and then the NASDAQ is up probably about 0.6%. So we are up. There is significance to this upward movement, but I would take that with a grain of salt. So yesterday we saw it up also significantly, and then we traded down throughout the day. And that is a pattern that we see in downward trending markets. You open higher, you close lower. You open higher, you close lower. The opposite is true when you're trending upwards. We have a tendency to open a little bit lower and then trade higher. Open lower, trade higher. So this pattern, if we keep seeing it, it's going to indicate downward pressure in the markets. But we'll see how much of this is a reaction to the economic reports that were coming out and how much of it was the natural flow upwards. So we'll go over here and look at, okay, we can see that at least in the S&P, the SPY pre-market, it doesn't look like the reports really did anything. And then in the futures market, you can see big range, and it did create volatility in the futures market, but not real directionality. Here we got a big range. It went high, it went really low, it ended in the middle. So it didn't have a big impact in terms of direction. We are going a little higher after that, but there's a delay. There's a delay in the futures that says 552. Okay, so this, we're not going to look at that futures one. We'll just look at this S&P, since they're pretty much doing the exact same thing. It traded up, now we're trading back down. You see that? So even though the futures are moving up, it started to trade down, and then we're just further along. We have real-time data on the SPY, so we'll look at that. It's trading down. So the previous close right here, I guess I should move it a little bit lower. But you can see that, yes, we are likely, unless in the next 20 minutes we keep on trading down, we are likely to open a little bit higher than where we closed yesterday. And if we keep this downward trending movement, then eventually we're going to crack to the downside. So on a daily perspective, we've been chopping sideways. That's so messy. Where did all these come from? Okay, let's delete some of these. This is what we drew yesterday. I'll keep that one there. On a daily basis, we've been moving sideways or slightly upwards. So we've been moving upwards, but in this last week, it's really just been sideways. And it's been on light volume. So any directional movement on light movement is not sustainable. We need volume in order to keep the trajectory of that movement going. So there's just more signs that we're petering out, that eventually we will start pulling back, and we just have to be patient for it. And we'll let people who are letting their emotions and their exuberance get the best of them to stay in this market and continue to believe that it will go higher. But there's just too many signs now. There's too many signs now that we're going to pull back, and at best, keep on chopping sideways. The other thing that I was looking at yesterday is we talked about VIX, and we talked about a January VIX in the pre-market session, and then we decided to shift our attention back to December 29th. But if we continue to look at that January, because the institutions will focus a lot more on, there's a lot more volume on these monthly expirations than there are on the weekly expirations. So if we want to see what institutions are doing, they're more likely to show up in these monthly expirations rather than weeklies. So if I go over here and I look at this monthly expiration for the VIX, something interesting happens. Look at this open interest, and we don't see the volume anymore, but yesterday there was a few really interesting volume actions. But take a look at these numbers right here: 10,000, 19,000, 41,000, 103,000, 115,000, 134,000, 185,000. We have another 120 right here, 112, 260, 321, 225, all thousands. What we notice is what the trade that we examined yesterday, we went in the money to be conservative. And we said, well, VIX should spike at some time between now and January, but let's be conservative. Maybe it floats down a little bit. And we went with, I believe it was 11 or 12 strike. But look at the huge amount of open interest in these out of the money: 17, 18, 19, 20, 21, 22, 23 has 112,000. This 26 has 320,000. These are a huge number of open contracts far out of the money, which means that there's a huge amount of money, millions. In this 23 strike alone, we're talking about probably around 6 million that traded yesterday. And then, so there's tens, if not hundreds of millions over here in these higher strike prices VIX calls, which means that some large institutions are willing to bet tens, if not hundreds of millions that we're going to spike quite high, because they don't make money. If I go over here and I buy a 23 at 74 cents, that means I break even if VIX goes to 23.75. Just break even. And they're not going to put tens or hundreds of millions of dollars on the line just to break even. So they believe that it's going to go significantly higher than 23, which is really interesting. Okay, so we were conservative, but there's institutions here that are betting really large on, look at this one, 228,000 contracts that it's going to go to 47.5. That's crazy. That's crazy. Of course, it's a lower dollar price for the contracts out here, but it's still, so someone is putting at least $500,000 or $1 million over here. That's crazy. That's crazy to me. So there is some large institutional trading betting that the VIX is going to spike up between now and January. So that's another clue that somewhere behind the scenes of this flat movement in the S&P 500, institutions are gearing up for a pullback at some point in time. So we're going to sit patiently. We're going to just stick to our view that we are going to have that pullback. Of course, overall, we are in this uptrend. So the overall direction of our portfolio is up. And then we have a few trades that will take advantage of a pullback. Other than that, there's not too much to say, because basically we're almost identical to yesterday's situation. Yesterday we opened higher, we traded lower just to close wherever we closed the previous day. Today we're opening higher, and then looks like we may continue to trade lower. And then if we just end up at yesterday's close, then it's going to be the exact same. I don't even have to move any of these lines, because yesterday all we did was fall within these exact same lines. And then so we just matched a high, we didn't match a low, and we closed at the exact same place. So I don't even have to move any of these lines. So we're just going to see what happens. Same thing as yesterday. If we start breaking some of these previous highs, and with significant momentum, then we could trade higher. But otherwise, we're just going to see if we break the previous close and continue to trade lower, or if we're just going to chop sideways. The other thing now, it's going to if any volume comes back. And if it doesn't, then we're going to be in that scenario that I talked about, where we're just chopping sideways on low volume. And that means the upward momentum just keeps getting bled out. And then that pullback is just more imminent. We could take a quick look at the economic reports, but it pretty much told us the story in the trading action. It was probably pretty much very close to the consensus. So core PCE year on year, that's what the Fed is looking at. Previously had 3.7. We believed we would get 3.5. We got 3.5. So we're just spot on. And PCE is coming down a little bit. So the Fed's viewpoint that inflation is coming down seems to be true. But what we need to see is it sustaining? Is it going to continue to move downwards? And the bond market, let's see what the bond market did. Yeah, the market, it's up. Is this yesterday? Today. That's yesterday. Let's see the intraday. Look at that downward movement. Yeah, just continuing. The bond market is down. So that's going to put pressure on the equity markets as well, especially QQQ. So again, a lot of signs that we shouldn't be over enthusiastic about a sustained movement upwards. And what I shared with you yesterday is we do have a couple of resistance levels for our market to go through if it does break to the upside. And if it breaks to the upside, then it just becomes that much more likely that we'll pull back from those higher levels and shake out hands. So algorithms will shake people out who get over exuberant with the upward movement. I think that's going to be it. We did have some, what was it? CRM, Salesforce reported earnings. Looks like they did okay. So that's maybe behind some of that gapping at the open today. Although it's going to be a baby gap at this point if this keeps trading downwards. And that's about it. So there's not a lot of stimulus. There's not a lot of news items at this point that can continue to drive the market higher. So we got positive news on the PCE front. That was the one big, huge news item other than GDP this week. So we're not going to have those news items next week. And we don't have any really significant earnings coming up. I didn't check next week, but we're pretty much at the tail end of earnings season. So we shouldn't really have any large companies reporting or significant companies reporting next week. So there's nothing coming up that could give this market a big boost, stimulus upwards. Unless Powell is speaking tomorrow, unless he just says something really crazy out of the blue. So really, we're just going to wait and see. The viewpoint is that we're going to continue chopping sideways or we're going to pull back. But at some point, we're just waiting for that to happen. And as we get closer to the end of the year, trading volume starts to dry up. Institutions are starting to shift their portfolios into what they're going to hold into the end of the year. They don't want a huge amount of trading in and out during those last couple of weeks because volume is thin and they need to position themselves for the best possible year end that they can have because their bonus is based on their performance for the year. So they don't want anything wild happening in that last month. And that's why you see a lot of tendency to rotate out of, for example, tech stocks, highly volatile stocks, and into blue chip stocks during the end of the year because we want a more stable portfolio. So we have a more predictable bonus check at the end of the year. So that's also going to be, we talked about how there would be a sector rotation from leaders to laggards, and that meant for this particular year out of tech and into blue chips. While we have a year-end seasonality effect doing the same thing because people don't want volatility inside their paychecks, so or their bonus checks. So we should see that rotation continue further into the first couple weeks of December, and then things will get really quiet. So if we're going to get a directional move, it's got to happen in the next 2 weeks. That's it for today. We're 15 minutes before the open, so we'll just go ahead and get ready for that open, and I'll see you in the aftermarket.